Hello, and welcome back to another series of Camtasia video lectures. In this series of videos, we're going to be talking about Chapter 5. Now, the theme of Chapter 5 is CVP analysis, or cost volume profit analysis. And this helps managers to understand the interrelationship among three things. And those things are cost, profit, and volume. And it does this by focusing the manager's attention on the interaction among the price of the product, the volume of the activity, the per unit variable cost, the total fixed cost, as well as the mix of products that are sold. So it's really an important tool that is used in many business decisions. Some business decisions would be what products and services should we offer, what prices should we charge, what marketing strategy could we use, and what cost structures should we maintain. Okay. So before we jump right into CVP analysis, we need to really understand and keep in our minds that there's actually three key assumptions that underline our CVP analysis. The first key assumption is that our selling price should remain constant, okay? And what that means is the price of a product or a service is not going to change. However, volume will change, meaning our selling price will stay the same, but the amount of product or the number of products that we sell are going to change. Okay, so instead of selling 100 units at $15, maybe we sell 150 units, but we're still keeping that same selling price of $15. The second assumption that we need to remember or keep in mind is that costs are linear, okay? Meaning they're in a straight line, okay? And we assume this linear function, and it allows us to accurately divide our costs into variable and fixed components. So as we get into the CVP analysis, remember, costs are linear, right? And because they're linear, meaning they go up at a straight, at a constant curve, right? Or a constant straight line. And the reason why we assume that is because we need to segregate those costs into variable and fixed, okay? The variable costs, those are going to remain constant per unit, okay? And fixed costs are going to remain constant in total as long as we're within that relevant range. So this second assumption really calls into our understanding of how variable costs and fixed costs behave. And we talked about that in Chapter 1, right? Remember, we said that fixed costs in total change in direct proportion to changes in levels of activity. However, variable costs on a per unit basis are going to remain the same. They're going to remain constant, right? And we said that fixed costs in total remain unchanged, meaning they remain the same, again, as long as we're within that relevant range. So the third assumption that we hold when conducting CVP analysis looks at multi-product companies, okay? And a multi-product company is nothing more than a company that sells more than one product, okay? Instead of selling, take for example BIC, right? The stationery company BIC, right? Not only do they sell pens, but they sell pencils as well. So they're a multi-product company, okay? When we're conducting CVP analysis, especially in a multi-product company, we assume that the mix of products remains constant, meaning we sell 5 pencils for every 2 pens sold. And we keep that mix, okay? And that allows us to conduct CVP analysis. It makes it a little easier on us, okay? So now that we got these assumptions on our belt, now we can turn to our first learning objective. And we want to, hopefully after this video, we'll be able to explain how changes in activity actually affect the contribution margin as well as our net operating income. Okay? Now, the contribution format income statement. This comes again into play. I told you in chapter 1 that how costs behave and the contribution format income statement is going to be something that keeps coming up in our study of managerial accounting. So here it is again. The reason why we use that contribution format income statement is because it's helpful to managers when they're judging the impacts on profits of changes in 3 things. And those 3 things are going to be the selling price, the cost, or the volume. So let's look at this example that we have here. It's a hypothetical contribution formatted income statement for a company that makes bicycles. They're called Racing Bicycle Company. And notice what we have here. In this contribution formatted income statement, the emphasis is always on cost behavior. How do costs behave, right? And remember, variable expenses are separated from the fixed expenses, okay? Very important that we remember how variable costs behave, how fixed costs behave, and how to put together that contribution format income statement. Now, the contribution margin, right? This is very, very important. It's going to be a key jumping off point when we conduct CVP analysis, as well as it's a number that we're going to use to help us calculate any change in net operating income. So what is the contribution margin? Well, we define the contribution margin as the amount remaining from sales revenue after variable expenses have been deducted. So when we look at the contribution margin, we say, okay, this is what is left from our sales number or our sales figure after we have deducted variable expenses. Okay, now keep in mind that this contribution margin that we have here, this contribution margin, not only is it's what's left after variable expenses have been deducted, but the contribution margin goes further, right? The contribution margin is what is used to cover fixed expenses. Any remaining contribution margin contributes to our bottom line or our net operating income. So what we say here then is that the contribution margin, it's what's left of sales after variable expenses have been deducted. It goes to cover fixed costs, and hopefully it's going to contribute to our bottom line or the net operating income. Whenever we conduct or do contribution or CVP analysis, it's always a good idea. In fact, this is a rule of thumb. Whenever you're doing CVP analysis, it's very useful for us to take sales, our variable expenses, and the contribution margin, and not only express these in total, but also express them on a per unit basis like we see here. So let's look at RBC. Okay, so for each additional unit RBC sells, right, we see that as it is right now, they sell 500 bicycles. The per unit cost of one bicycle is $50. The variable expense of producing this bicycle is $300. We have $200 of contribution margin. So what this means, or how we can interpret this, is by looking at that contribution margin, that $200, and we can say that, hey, for every additional bike or bicycle that RBC sells, $200 in contribution margin will help cover fixed expenses and provide a profit. Okay? So let's look at the bottom line here. Okay, we see that we have $20,000 of net operating income. But look above that, we have our fixed expenses. So notice that each month RBC has to generate at least $80,000 in total contribution margin to break even. So this is what we call our break-even point, the $80. Okay, what is the break-even point? Well, the break-even point is the level of sales where profit equals zero. Okay, so if RBC sells 400 units a month, it will be operating at the break-even point, right? How did we figure that out? Well, very simple. Okay, we see ourselves as 400 bicycles. 400 bikes times the selling price per unit of $500 gives us $200,000 in sales revenue. Okay. From that, we need to subtract out our variable expenses, right? Notice our total variable expenses are $120,000. How did they get that? Well, they took the variable expense per unit, which is $300, and they multiplied it by the sales volume, which is 400 units. That's how we got the $120,000. Now, when we take the sales, subtract out our variable expenses, notice we have a contribution margin of, bear with me here for 1 second. I'm sorry, I wanted to see if I can somehow grab a pointer with my PowerPoints, but it's not letting me do that. Hopefully you can see my mouse here. So we're taking our sales, subtracting out our variable expenses. We have a contribution margin of $800 or $80,000, right? This $80,000 in contribution margin goes to cover the fixed costs and provide a net operating income, right? But unfortunately, we only sold 400 bikes. We generated enough contribution margin, and remember, contribution margin says that variable expenses have already been deducted. Okay? Once we deduct those variable expenses from sales, we have the contribution margin. That contribution margin goes to cover fixed expenses. Well, in this case, we are covering our fixed expenses of $80,000. That means that we have zero profit. Okay? What happens now if RBC sells one more additional bike? So instead of selling 400 bikes, we now sell 401. What happens? Well, previously, we defined the contribution margin as first is what's left after sales have been deducted, or is what is left from sales after variable expenses have been deducted. And it first covers the fixed cost, and any remaining contribution contributes to the net operating income. So this is like at the right point to show how one more bike is going to increase our net operating income by the amount of the contribution margin per unit. Okay? So let's think about it this way. We sell 401 bikes, right? We have an increase in our sales revenue. Sales revenue is $20,000 or $200,500. How do we get that? Again, sales volume times the sales price. $500, selling price per unit of the bike, times the volume, 401, gives us $200,500. We need to subtract out variable expenses. We have $120,300. How in the world did we get that? Guess what? We took the per unit variable cost, multiplied it out by the sales volume, which is 401. That gives us $120,300. When we subtract that variable cost from our sales, we get the contribution margin. In this case, the contribution margin is $80,200. The contribution first has to cover our fixed expenses. Okay, it does that, right? Our fixed expenses are $80,000, which gives us a net operating income of $200, which incidentally is the amount of our per unit contribution margin. Okay, so keep in mind that once we hit the break-even point, any unit above that break-even point that we sell, the contribution or the net operating income is going to go up by the per unit contribution margin. So what if we said, what if they sell 402 bikes? Okay, they sell one more bike. Instead of selling 401, we sell 402. What is my net operating income going to increase by? Right? Well, we know we're above the break-even point. In fact, we're 2 units above the break-even point. That means that my contribution margin is going to go up to $400, right? So it's important here to really understand the contribution margin, to how it's defined and what it does. Why? Well, the reason why is because we have a shortcut here. Okay? If we want to do CVP analysis and we know we're above the break-even point, we do not need to prepare a contribution formatted income statement to estimate profit at a particular sales volume. We have a shortcut method. That shortcut method says multiply the number of units that are sold above break-even by the contribution margin per unit. So let's look at this example. If RBC sells 430 bikes, okay, how much will its net operating income go up by? We do not need to prepare a brand new contribution format income statement calculating out our sales volume at 430 bikes, costing out the variable expenses at 430 bikes. We don't need to do that. We have our jumping off point, which is our contribution margin. And again, our contribution margin is what's left after variable expenses are deducted from sales, and it first goes to cover fixed expenses and provide a net operating income. Okay? So we know our break-even point is 400 bikes. All we need to do is take the number of units that are sold above break-even point, which is 30. We multiply that by the $200 per unit contribution margin, and we see that RBC will have a net operating income of $6,000. Now, there is a equation for the CVP relationship. And when we're looking at the CVP relationship, basically this equation is really the contribution formatted income statement. So what we're saying here really is that the contribution formatted income statement can be expressed in equation form. That equation is profits equal sales minus sales minus expenses, specifically variable expenses. That gives us our contribution margin. From the sales minus variable expenses, we subtract out fixed expenses. okay? So let's look at an example of how we can use this equation, which is basically the contribution formatted income statement, to calculate our profit or our net operating income. So how do we calculate sales? Well, again, it's the sales volume times the unit sales price. So we have 401 units times $500. We subtract that from the total variable expenses. Well, what are our total variable expenses? Well, again, we're taking the per unit cost times the sales volume. So we take 401 units times our unit variable cost of $300. Then we subtract out our fixed expenses. Now, keep in mind that fixed expenses are never, ever, ever expressed on a per unit basis when we're doing CVP analysis. We never do that. Why? Well, because it has to do with the definition of fixed expenses and how they behave. Remember from chapter 1, fixed expenses in total remain constant as long as we're within that relevant range. However, on a per unit basis, fixed expenses have an inverse relationship with volume, meaning on a per unit basis, as volume goes up, our per unit fixed expense goes down. That gives us the impression that, hey, the more we sell, the less our fixed expenses are, because on a per unit basis, our fixed expenses are going down as sales volume goes up. It's a wrong way to think about it, because we know in total, fixed expenses never change, again, as long as we're within that relevant range. So they run the numbers at the bottom of the slide here, and we see that, hey, our profit is $200, right? Same exact answer we got when we looked at the contribution formatted income statement. So what do we do when a company only has one product? Well, if a company only has one product, we can actually refine that equation, that profit equals sales minus variable expenses minus fixed expenses, and we can reformulate it, okay? Now, it's important to know, or important to understand, that we're always taking a quantity times a price or quantity times a cost, okay? So, we only sell one product, right? How do we calculate our sales volume? Well, that's easy. We take the quantity that we sell times the selling price per unit. How do we calculate our total variable expenses? Again, we do it the same way. Variable costs per unit times the quantity sold. Then we subtract out our fixed expenses from the difference between sales minus variable expenses. So we can really use this equation. It's very helpful for us, especially if we're in a company that only sells one product. So we can use this refined equation, and we can demonstrate here how if RBC sells one more bike above break even, which is 401 bikes, we can see how that profit equals $200, which again is the contribution margin per unit. $500 is the selling price per unit times 401 units minus $300, which is our variable expense per unit, times the quantity. Again, how many bikes did we sell? 401 bikes minus $80,000, which is our fixed expenses. We get a profit of $200. Now, the profit equation that we're looking at here, we can also express this in terms of unit contribution margin. Okay, how do we do that? Well, very easy. We can say profit equals the unit contribution margin. Unit contribution margin is nothing more than price per unit minus variable cost per unit. We take that unit contribution margin, multiply it by the quantity, subtract out our fixed expenses. So, let's beat a dead horse again. Let's look at our example, right? What is our unit contribution margin? Well, it's $200. If we multiply that unit contribution margin of $200 times our quantity, which again is 401, we get the total contribution margin of $80,200. We subtract out our fixed expenses. Guess what? Profit is still $200. So before we jump into our next video or next learning objective, which we'll push that to another video, I just want to review the concepts here because it's very important that we understand we're always taking, we can either look at this in total, as we see in the total column here, or we can do it on a per unit basis, okay? So like I said before, a good rule of thumb, whenever you have your totals here, create another column that says, hey, let me give you my per unit price. Let me give you my per unit variable cost. And let me calculate that per unit contribution margin. Because that per unit contribution margin can be used to multiply it by the quantity, subtract out the fixed expenses. That shows what our net operating income is, okay? We numerously defined contribution margin, so it's very important you understand what that contribution margin is, how it works, what it does, okay? We looked at a number of equations here. It's all the same equation, we're just refining it further and further and further, right? First, we said that the contribution formatted income statement can be expressed as an equation. Sales minus variable expenses minus our fixed expenses. That gives us our profit. Then we broke it down a little further, right? We said that, hey, if we only have one product, we can fiddle around with the per unit basis and say, okay, well, if I take my quantity times my selling price per unit, that gives me my total quantity, or my total sales volume, excuse me. If I take my quantity sold times my variable expense per unit, that gives me my total variable expense. Then I subtract out my fixed expenses. I end up at my contribution margin, or I end up at my net operating income. Very important to recognize that, again, that unit CM, or that unit contribution margin, can be our jumping off point, right? So we can refine that equation even further to express the profit equation or the contribution formatted income statement equation, and use that unit CM and multiply it by the quantity and subtract out those fixed expenses so we can figure out what our net operating income is, okay? When we come back, we're going to continue to talk about the CVP relationship, but we're going to look at it in the form of a graph. Okay, so tune back in for that one.